Hello learners, welcome to today's lesson. I am Kezia Wanjiko. We're going to look at accounting for VAT. Now previously, in our last lesson, we looked at key terms that are used in VAT, and we defined terms like supply, what it means to supply, whether you're supplying goods or services. We looked at tax point, where we said that tax point will define the date or the month in which you account for VAT, which will be the earliest of when you issued an invoice or received an invoice, and when you made a delivery, if you're doing construction contracts, when you received a certificate from a supervisor or from an architect, and the date that you received or paid a portion of the goods that you are paying for. Then we went ahead, we looked at other terms, like what it means to have made supplies and the types of supplies. We said we have two types of supplies for the goods and for the services that you'll be providing, which is what you called supply. You're going to be doing that either at a standard rate or zero rate, what we call the taxable supplies, or you're going to make a supply that is exempted from taxation, which is an exempt supply. So we're going to carry on from there, and for today we're going to look at accounting for VAT. There are four main things that you need to consider when you're accounting for VAT. Like we had said earlier, everything in VAT is going to be guided by the Act, which is an Act of Parliament that has already been passed. So the first thing you do is that once you get registered for VAT, we said you're going to be, as a taxpayer, you have some rights and obligations, and on the other hand, the commissioner has rights and obligations. Now, one of the obligations of a registered person is to issue a tax invoice, and that is the first document that you're going to consider when you're looking at accounting for VAT. So the tax invoice, the tax invoice is what in normal business activities we would call a receipt. But there is a difference between a normal receipt and the tax invoice. The reason is because in a tax invoice, you are supposed to issue it and the contents are supposed to be as prescribed by the Act. That is the whole difference. Now, once you issue a tax invoice, either at the point of supply or within 14 days from the date of supply, that invoice is very, very important, because if as a business you do not have tax invoice, either you bought, you didn't receive, or you sold and you did not issue, then that's a very serious omission. Without the tax invoice, you cannot claim input VAT. So it is the most important document as far as computation of VAT is concerned. So based on the amount that is contained in the tax invoice, you're going to now claim input VAT on the supply. So it simply proves that the product or the supply or the transaction is attracting VAT, and as a result of that, you have proof that you have paid VAT, and therefore you're entitled, remember one of the rights that you have, you're entitled to claim the input VAT from the output VAT that you will have collected from your customers. So we're going to go to the Act and we'll look at the format, the prescribed format or the contents of a return as contained in the VAT Act. So the return should have, the invoice that you're issuing should have one, name, address, VAT registration number, and PIN number of the supplier. The supplier is the business in this case. So the name of the business, the address of the business, the VAT registration number, and the PIN number of the supplier, then serial number of the invoice. Now, if you flash back to business transactions, the proof that there's an activity in the nature of business taking place is serialized transactions. So the invoice number is going to show that you're issuing these on day-to-day basis, or there are many transactions that this business is engaging in. Then there is a date of the invoice. So that is the date that will determine when you're going to, the month that you're going to account for VAT. Then there is date of supply, if different from the date of invoice. That is depending on the trade terms that you had agreed with your customer. Then the name, address, VAT registration number, if any, and personal identification number of the person to whom the supply was made, if known to the supplier. Now, we said in the last classes that registration is only for businesses, that individuals, flesh and blood, people are not registered for VAT. So for you to quote this number, it means the other party is also registered. Then the description, quantity and price of goods or services that is being supplied, taxable value of the goods or services if different from the price charged. That may happen if, for example, there will be discounts, that cash discount that is expected to be given to the customer should they pay promptly. Then the rate and amount of tax charged on each of those goods and services. What that simply means is that for the tax invoice, each item is going to have a rate. Now, yesterday I said there are two rates of VAT. It's either at 0% or it is at 16%. So you will have bought whatever you buy, let's say something like LPG, gas, 0%. And then you buy something else that has, let's say, juice, 16%. So those are the rates. Each item, the rate. Each item, the rate. And yesterday we said the value of supply, the selling price of that product, is the basis on which we shall apply the rate. Then there is details of whether the supply is cash or credit and any discounts, total value of the supply and the total amount of VAT, the logo of the business of the person issuing the invoice. This is the supplier's logo, and the identification number of the register. Now, the register here is an ETR, or an electronic tax register. Now, it's a very important piece of machinery when it comes to computation of VAT or accounting for VAT, because it is designed in such a way that it has a memory that is not erasable. So once you've already input information in that and it has printed out the invoice, then that information is kept for a period of time. That is important because if you get a visit as a business from the officers, from the commissioner or from his authorized officers, the first device they will want to access is the ETR, so that they can read whatever set of transactions that you've been undertaking, and then they can be able to compare what you've already declared and what the correct situation of the business. So the tax invoice, the one that is saying is the basis for VAT computation, must be produced from an ETR device. And that device, like all electronic devices, has a serial number. So that serial number must appear in the invoice for that invoice to be valid. So that means that if, for example, the commissioner has an invoice, they are able to trace back to the ETR that produced that invoice, and if they feed into that machine can actually give it can give a copy of the invoice that it had already printed. We had said in our previous class that if you're selling to the final consumer, that means you're a retailer, we said that you're supposed to quote prices inclusive of VAT, because the final consumer is the one who bears the final burden of taxation or the tax incidence for VAT purposes. Now, if you're selling to final consumer, you can take all the contents that you have discussed and you summarize the contents that is provided for by the commissioner in the Act. So, according to the Act, a simplified tax invoice, like the one you're going to issue to your customers, your retail customers, should contain the name, address, VAT registration number, and personal identification number of the user of the register, that is the business that is making the supply. Then the logo and identification number of the business. 3, serial number of the receipt. 4, the date and time of issue of the receipt, and the name, quantity, unit price, chargeable tax rate, and the value of the recorded sales of the supply. Then tax amount payable, and the total amount payable, inclusive of VAT. So that is the very first thing that you must ensure that you have before you compute the VAT. So have a valid invoice that is going to be within the prescribed format by the commissioner. Then the other thing you need is input tax deduction. Input tax deduction. Now, input VAT is VAT that you pay to your suppliers on taxable supplies. Now, supply can either be goods or services, so long as it is within the scope of VAT. It is a taxable supply. So when you talk of input tax, it's saying in every business you will have the input-output cycle. So the normal business cycle is a business acquires inputs from its suppliers, and then it processes the inputs, or the inputs go through a series of activities within the business so that the business can convert the inputs into output. This is the normal business cycle. So collect or acquire inputs from the suppliers and then process that into output. So these inputs could be, for example, raw materials or taxable services like audit, legal services, and such services. So you take that and then process, then output. So the input VAT will be VAT that you pay on your inputs. Then output VAT, like you're going to see later, is the output that you charge or the tax that you collect from the customers. So this you sell to the customers, and from that you collect output VAT. So on that side you have customers, and on this other side you will have your suppliers. So it means that input VAT is paid to suppliers, while output VAT is collected from customers. We'll talk in detail about that much later. So input tax deduction. Now, in our previous lesson, we said that after classification of goods or services into taxable and exempt, you're only required, or the commissioner will only allow you to deduct input VAT, what you've paid to your suppliers, relating to taxable supplies. So it means that for you to be able to deduct input VAT, there must be corresponding output VAT. So that corresponding output VAT is either at 0% or at 16%. So long as that, at the time that you are selling those goods or at the time that you're providing those services, they are still within the scope of VAT, then there will be taxable supplies. You will be able to charge output VAT, because that is one of the obligations, again, that you have under the Act. And as a result of that, any VAT suffered can be deducted. So that is what we mean by input tax deduction.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.